New all-time highs in the S&P, the Dow, the Nasdaq. The market's chugging away higher to the upside. We're going to break down today's move in the context of a maturing intermediate run. What other signs of weakness may be cropping up out there, at least which ones we should be watching for coming up in this next week or two. Again, riding the trend as it continues to move. And we've been doing very well in our class portfolios with our bullish trades, but also being aware of if and when this train might dock for a while, or hit the station, I guess would be the right terminology, for a while. So I'm going to break that down in today's video with the different technical signs that are out there, as well as our trade idea in a stock that has been on its own little bearish trend, death cross environment for a while, and it's finally turning around. So let's go ahead and get started. Today is Thursday, January the 9th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. So we got up to a new high again today. Near-term line rallied above to a new high as well, getting in the upper reversal zone. In fact, 3 of the 4 lines in the upper reversal zone. A bigger range would have probably got the momentum line, but since it was a smaller range, the momentum line stays down. Again, we're now going almost on 3 months of this intermediate rally that we've been on. I've got Fibonacci lines drawn here. This is for the market sentiment pullback. Keep in mind that I really believe that this was the beginning of a new market sentiment run, even though the market sentiment line did not drop below 50 here. It did for the Russell, it did for crude oil, it did for other things. It did not for the S&P, but it came really close. So we had this bout of volatility that brought the market sentiment line down, really kind of a longer period than that even. That started over here actually. So this bout of volatility is what, we had this cluster, that brought the market sentiment down and everything else. And I believe that this is the beginning of a new market sentiment run, which typically lasts 6 to 9 months. So we are now into 3 months of this run. So, but that's usually the long end. So this is of the actual market sentiment rally off of the December 24th low. So you can see where the 23% retracement of that big old move kind of lines up. Actually, it lines up above these old high points here, and right in the middle of the Fibonacci retracement zone of this intermediate run. You can kind of see where the pullbacks, the levels for that is. So, the 62%, the bottom of the retracement zone is right where these old highs are. So there's going to be some pretty good support there. That's probably, if we get down to anywhere in that retracement zone, that's probably going to mean that we're getting the intermediate line's pulling down like this below the moving average, and we're getting dark pink shading, and we've really pulled back. More than likely, what I'm expecting here is, at some point in time, when we do get a pullback, it will get below the moving average. We'll get to that 23% retracement. We'll get pink shading and a yellow line, which at that point would actually be a bullish signal. Now, it would have been better had we gotten that, say, a month into the intermediate run, and we're now 3 months in. So that makes it a little concerning in terms of, if we were to bounce off of that, what would be typically a bullish signal, how much are we going to bounce, right? Because, considering that we've been on this run for a while. Every intermediate pullback starts with that same light pink shading and yellow line. So as bullish as that signal is, it also precedes just about every intermediate pullback that we get. And again, the intermediate pullbacks occur when you drop really below that 30. When you just dip below the 30, which is where the 23 is, then that's usually not an intermediate pullback. That's usually just the intermediate line drops below 80, and that's not it. It doesn't get all the way below 50. And that's kind of what I expect here. You can see the Russell is not getting up to new highs, and it actually went down throughout the day today. Its near-term line did not get in the upper reversal zone, and it actually still is in the process of forming a bearish high point. So, we're not completely risk on here in the Russell 2000 with the market forecast. In fact, its intermediate line is the closest out of all of these to dropping below 80. Right, the rest of these are pretty strong: 95, 89, 92.5. So pretty strong intermediate trends, except for the Russell, which is the one that's not forming the new highs. I mean, look at the NASDAQ, because that's driving a lot of this bullishness here, those types of stocks. Look at the Dow Jones, all new highs for that, and close to a cluster. If you look at the Dow Jones Industrial Average, it's had this same intermediate run here, and that started back here in October, same time frame. It's had a little bit more pink shading, but again, see yellow line, pink shading, that's a bullish signal. So, but still 3 months, and if we get a cluster 3 months in, so it doesn't mean that we're going to immediately roll over, but it's definitely a sign of weakness from the market forecast. So we got a strong bullish trend on the market forecast. It's a mature trend. So when you have mature trends, you still ride them. You just have to understand and watch for signs of weakness that would suggest that, you know, it's run its course and is looking more for that breakdown. I'll talk a little bit about what some of those signs are here in just a minute. But before we do, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video too that will notify you when these videos are posted. Hit the thumbs up icon down there. That tells us you want us to keep doing the videos. If you don't like the videos, you don't have to click anything. If you want us to do this video again tomorrow, let us know by clicking that thumbs up. Comment down there on what you got out of the video today. Join our website for free at marketscholars.com. There's a link popping out top right corner of your screen. Click on that link to subscribe. You can follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching this on our blog here at marketscholars.com, we invite you to check out our classes over here on the right. They're available for all of our classes. All of our trading rooms are available for our Plus subscribers. You can click this link for more info on that. You can also get there under our pricing column. Plus subscribers are our monthly subscribers. Our premium subscribers get access to everything the Plus subscribers do, plus all of our custom content, including the scripts you see on our charts. We also invite you to engage with us on social media. Hit this little heart right there. It opens up a new window. You can click on, where to go? Click on, there it is. Click on that like button. Actually, it doesn't show up there. You can also click this thumbs up, and you can like today's Market Outlook Facebook post. Again, the more you engage with us on those platforms, the more they will promote our content to the top of your timeline. They do that with the content that you engage with the most. We try to make that really easy for you here. All right, now let's take a look at the weekly chart here. Look how strong the trend is. We're starting to get some long upper shadows, though, relatively long upper shadows. So that's something to keep an eye on, but nothing too concerning. We still got a strong bullish trend. We're just not closing above the prior candle's highs. That's the strongest of bullish trend. Again, the PPO is really high, so at some point in time, you know, things are going to slow down. It doesn't mean we'll have to come down, but we can slow down, especially when we're this far above the 50-day moving average, which is what's in orange. Looking at the 3 green arrows, this is kind of what I told you about before. In fact, you can see we got another green arrow there, but look at the 2-line versions of this, and you can see the MACD's turning up again. So that means we're diverging again. The 8's pulling away from the 17, and it's price that pulls it away. So really, until we really flirt with the 17-day moving average and break it, that's when we have a mature trend. Let's go back a couple, to the yearly chart here. When you have a mature trend, as soon as you break that 17-day moving average, that's when we're pretty much done. So as long as we're still holding, you can see over here we broke it a couple of times when the trend was starting, and we hit the 30 and bounce, right? We had the light pink shading. Over here we got light pink shading and the green line on the yellow line, excuse me, on the market forecast, and it bounced. Well, over here, not the case because we were so mature. Same thing here, same thing over here. So now that we're so mature, I don't expect light pink shading in the yellow line to give us a bounce signal. If it does, maybe another near-term run before things are over with. So here we're pulling away right now, but as we pull back, watch for it to hold the 17-day moving average. I think there's got to be some time for these lines to converge on each other and bring the MACD itself in blue lower, so bringing the average lower before things start to really pull back, right? You can see you got the surge and then you come down. You got the surge, you come down. before. So we've got the surge, and we're still not really coming down yet. So we're not really converging yet before we break. So that's something to keep an eye on here. Now let's look at the intraday chart, and you can see here that we're pulling up. We're 13 points. We're getting close to that 5% stretch again. Remember, this is going to keep moving up. So in a few more, by the end of the week, the low point will be way up here to 319. So there's some room for the S&P to keep going up without getting too stretched because of how far the low is moving up pretty rapidly. You also see too, that we bet a lot of volume in this area. In the new year, coming out of the new year with the sideways move, see the volume nodes we have coming on here, and we're getting relatively high off of that. So, in terms of like a path of least resistance, there's really not one, right? Because it can just as easily go down as it can go up because there's not very much volume lower until you get down to that 323 level. So keep that in mind in terms of risk management, that, the tightrope's getting higher off the ground. The ground's really down here, getting way low where that point of control is, but you do have a good area, a good platform here, but that's how far down or far up off the ground that we are right now. So just accommodate that with your risk management there. If you look at the volume today, you can see 48 million shares coming in below the average. The trading range was well below the average, but you have to keep in mind the gap. So we close at 324.45. The low today at 325.52. So about a point. So add on another point, and it's right there. So a little bit below average on the volume at 48 million, which is remember the average is really low as it is, so way down here. And then the trading range at at the average, which is also very low. So we're entrenched in this trend. The 1% mark on the ATR, which is what this tells us, is 3.26 points is where the ATR would have to get to. So that means we'd have to have multiple days above that in terms of ranges, and that usually comes with some bearish moves. So we are entrenched in this bullish trend right now. If you take a look at the intraday chart, the volatility chart is what I wanted to say. Look how we continue to go down. So, and I expect we'll probably end up going down throughout most of the rest of this week, going into tomorrow. We'll continue to go down and probably approach closer to 80%. That's what we do at the end. I mean, there was a jump here on Friday going into the weekend after the new year, where we jumped up and pulled back on some, on geopolitical concerns, and we opened up the weekend, jumped up higher before coming down. But generally speaking, when you look at weekly charts of volatility, you see how we close at the lows of the week more often than not. And I would venture to guess it will probably end up closing at the low of the week this week too, which means probably a little bit of a drop tomorrow in volatility down to probably towards 12, if not below. So, and bringing this down as well, and giving us opportunity if you want to buy volatility cheap. It's a lot cheaper than where you would have bought it at the open of the week when it was up closer to 16. So to summarize, the trend continues to be very strong. It's a mature trend, but that doesn't mean it's in a euphoric trend. We're not hitting euphoric highs. It's just mature, and mature trends continue to run. They continue to run there. We are starting to see some signs of weakness, and there's a few that we can kind of keep our eyes out for here in this upcoming week or two. But expect more slow grinding convergence with lower volatility to occur over this next couple of weeks before we start flirting with more of a breakdown on the intermediate line, whether it's initially just to the 23% line or eventually to that 38% line, where we'll get more of bringing that intermediate line down, which will set us up for a new intermediate run, because like I said before, we're at the beginnings of a long-term run, not at the ends. I still think we're in the early innings of that run that started here in late 2018, October of 2019. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Hit that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below on why. What are you seeing that suggests either you're a lot more bullish than I am or you're a lot more bearish than I am? In terms of how what's driving the price action, it's interesting moves, dichotomy of moves here. On one hand, we were risk on in terms of emerging markets doing well, the large cap stocks doing well, and gold dropping. But on the other hand, a little bit of a risk off move with crude oil dropping the most and long-term bonds rallying, and the dollar being strong. So it's kind of a sideways action. We're not really getting a clear direction one way or the other. If I were to go back to let's go back to the last 4 weeks. So that would be right here. Whoops, excuse me. Let's try this again. It'd be right. That'd be 1, 2, 3, 4 weeks, and we'll go back to that hourly chart. So here's the 4-week chart. You can see gold and crude oil had been strong. Crude oil pulling back some of those gains with the dollar as weak as it's been, and long-term bonds have been flat. Pretty much everything has been flat, but another sign of that risk aversion, so to speak, is small cap stocks lagging, and that's really showing up. It's been struggling getting going, small cap stocks, but it's kind of broken out of a sideways action that's had for most of 2019. It's just slowing down on that initial breakout. Sometimes I shared with this chart with you, which is the 5 of the 7 biggest companies that are all kind of they're all cyclical. They're all either in XLK, XLY, or XLC, and that is Facebook, Apple, Amazon, Microsoft, and Google. So the other 2 would be JP Morgan and Berkshire Hathaway that are up there. But look at the sideways trend and the ascending triangle that's had for this growth area, and finally breaking out there too. So very, very good bullish signs. That's why I say, this is the beginning. This October low is most likely the beginning of a new run, a new long-term run that we got, because we've been consolidating pretty much since that August to October of 2018, where we've had multiple periods of volatility since then, and finally getting that breakout. And it's not just here in these areas, but you can also see too on crude oil. Crude oil is trying to break out and get going. A little bit of a transition. We've had this bullish breakout. We're getting above this 23% retracement level, which we hadn't done before. That close last week in crude oil is a very, very bullish close. It could be a lot more bullish if we continued higher. But since the geopolitical tensions have lowered, that's actually put pressure on crude oil to move back down to this really bullish pattern of light pink shading and a yellow line. So a good opportunity to either bounce or to reverse the trend. And as you see over here, last time we got that signal, we bounced. And considering that, we crossed over here in the beginning of November, so we're just over 2 months in. So it very well could have some more time before its intermediate run is over with. Let's take a look also at gold. And you can see the breakout it's had. And look at that long upper shadow, couple days of long upper shadows, starting to pull back with such a strong PPO, and also with this near-term divergence, the low point being right in here, right below. And if you look at the Bollinger Bands for crude oil or for gold, you can see coming into this area where the low in between the two divergent highs is big time volume node right around 1520. So any weakness we get on crude oil, about 30 points. Now keep in mind, if you look at remove all these and bring up a correlation chart, and you think, well, if stocks are going to go up, crude oil or the gold just can't. That's not how it works. Well, if you look at the correlation chart of gold to equities, and let's go back, let's give you some context here. For the most part, that is true. When you're below zero, I don't know why we're missing some data here, but when you're below zero, you have a negative correlation, and generally when gold goes up, the S&P goes down, and vice versa. But as you can see here, it's also spent some time up above zero. Not very often, but they can both move in the same direction. And typically when you're bullish, they can both move in the same direction here. And if that's what we are moving into, then expect to move higher in gold, along with a rising correlation from really, really negative levels back to really relatively positive levels, back above that 50% mark. One sign that's a little bit of a concern in terms of whether this intermediate run's ending is you can see that the trend, which measures the ratio of advancing volume to declining volume relative to the ratio of advancers versus decliners. So when we, looked at, we have how many issues we have going up, how many issues we have going down, and how much volume does each have. So if the ratio is is bigger on the volume, then you'll see a move up in this, which means we're getting more volume on the decliners than we are on the advancers, relative to the ratio between the two. Which, when you're going up, and you can see when you're going up, when you've been on a nice good trend and it's been neutral, once you start moving up, that typically to right around this 115% mark, that's usually when you get a bout of volatility. The same thing here, you can see as we were bullish, at the end of it, we were moving up and getting closer to that 115 level. Same thing over here, that eventually preceded that bout of volatility. So we're not moving up too high. We got up to about right here last time in November, initially coming off that low. So it's not back. It's not a sell everything you got signal, but it's something to say, okay, another sign of weakness as this intermediate trend may be getting close to running its course before setting up for a new intermediate run, new higher low, and subsequently new higher high. All right, now let's take a look at how the sectors are doing here, and we'll go to this comparison chart first, and let's go to same thing that we did before, and we'll look at the 4-week chart. So there's 1, 2, 3, 4. So we'll come over here and then go to about an hourly chart as well on that. And again, look how strong technology has been, which is mainly Apple right now. Look how strong communication services have been. That's like Netflix, Google, Facebook. And then look at discretionary, matching the market finally. It's been lagging and catching up to what the broad market itself is doing. So you have, those are your 3 cyclical areas. The market's been bullish over this past 4 weeks, and it's been led by the cyclical areas higher. You see that the energy and material sectors are actually down. So as bullish as we've been, that's a good sign that those are lagging, because they're lagging. They are lagging sectors. They'll start to rally at the end of a mature long-term run. And so this is a sign that we still have some room to go. You can see healthcare, real estate, utilities all up here, as well as staples, industrials, and financials, which have been 2 relatively strong sectors here recently. They have started to pull back. You can see there's financials and industrials for a period coming off of that October low point. They kind of led. In fact, here let's just go first straight to that October 8th low point that we had in 2019 up until now. Go to a daily chart, and you can see, along with healthcare and technology, they were the 4 horsemen of the beginnings of this long-term run, and financial still holding up okay, but industrials has really pulled back and is now kind of lagging the markets. But so those 2 areas had been strong, but you want them to give up their leadership roles to communication services, which was initially lagging, and discretionary, which is still lagging and still got some catch-up room left to go. That's retail, that's Amazon, and there's your real estate areas, which we talked about this idea of unwinding for real estate. If you look at the 6 months going into that October 8th low point here, and you can see just how strong that risk off move was, even though the market had been relatively bullish. They were up 8 to 10% when the market was flat over that 6-month period. So that unwind is going on right now from then going forward. But you can see there's still plenty of that unwind left to go. We're just barely getting started. Let's see. Let's go to today. Why is it not? There we go. If we go to today and go to a daily chart, We're just barely getting started on the unwind. That's only after that 10% rally for a 6-month period, 20% rally on a 1-year period. We're down a couple percent and flat on utilities. So, I mean, you look at the long-term chart for those sectors, like utilities here, and you can see just how strong it still is, right? And you look at like real estate, there's been a little bit more weakness in real estate, but you can also see again just how strong that still is. There we go. Just how strong it still is here. It's still, let's see, do I need to put on the log scale? I do. And then let's go out as far as it will let me go out. Yeah, that's as far as we can go. You know, that's still, I mean, it's still holding up at very high levels, close to its all-time highs. So we've hardly had the unwind in these safe haven areas that we really need to see to say, okay, now, you know, we are moving towards a risk-on move in the markets. All right, so for our trade idea of the day, which we've already placed in our market outlook category here, we're going to look at Cisco. You can see it got placed here earlier today before the market closed during our market outlook live. We also went through all of our existing trades, and we every day in the market outlook live we manage all of our existing market outlook trades. And for our premium members who have access to our real-time trade alerts, if I ever close any of these, then you'll get alerted to that in real time. So make sure you sign up for that service there too. But let's break down this long call spread that we did on Cisco. This is what the Analyze tab looks like for it. Here, let's bring that back up here. There's the maximum gain there at $50. There's the, it does have earnings coming up, so we position size relatively small. They're a little bit bigger than what we've done on other recent verticals with earnings come in the process because of the lower reward to risk ratio. So we're about almost 3.5 to 1 when you look at a 50% stop, which is what we normally do. That's a pretty decently, still a good profit loss ratio, but not as strong as some of the 5 and 6 to 1 ratios we've been doing lately. So it just means that we have a higher probability of success. Lower profitability means higher probability. Lower probability means higher profitability. So if we look at the charts here for Cisco, let's pull up the market forecast chart first. You can see it's been bearish. It's been on a bearish run here for a while. Lots of dark pink shading and just brief periods of dark green and green lines. Just very, very brief. Most of it's been on this bearish run. Well, now we're not so brief. We're up. We got dark green shading, dark green, green line. We are pulling back. We got the cluster though early on in the process, which really kind of helps solidify the trend. So if we do get light pink shading, it will most likely just be that. And again, just to kind of show you, if there's some examples here of what light pink shading does during the middle of a run. I mean, look at these when we got started. No cluster here, but you got light pink shading after a bearish run. Light pink shading, we continued higher. Light pink shading with a yellow line, and we continued higher. Light pink shading with the yellow line again. No red line on that pullback, and we continued higher. So it would not be a bad thing at all to get some light pink shading, but you can kind of see how the trend is starting to reverse there. In fact, if you look at the Bollinger Bands here for Cisco, you can see we're breaking through the node, and we're pulling back down to support now and using the node as support after having broken through. So staying in the upper half of the Bollinger Bandwidth and just pulling back down to it. Potentially using that for a support level. That's the idea, and then you'll trade through. If we get to 50, there's an opportunity for it to continue higher there as well. If you look at its DMI for Cisco, you can see that the negative line, after being on this bearish run this whole time, and the ADX being relatively bullish, lots of dark pink shading over here too, the negative line has finally dropped below 20. See, it was never below 20 this whole time. But it finally did drop below 20, the negative directional index. Even over here during this run, it never really dropped below 20. But now it is, and the positive had finally crossed above really 30 for the first time this whole time as well. and pulling back now. So a little bit of a pullback here, and if you look at the Ichimoku, the pullback is not really too concerning either. It's kind of a nice little weaker pullback just below the green line instead of getting below the blue line, which can happen quite a bit. A little flirting with the green line, still above the Ichimoku cloud, and can stay above it for a while. So you have the opportunity for a good bullish trend to develop. So we buy the at the money call, 47.5, 43 days away, and then we sell the $50 call to help finance some of that. So you end up, like I said, with that cost and position sizing just a little bit more than a half position because, number one, of the earnings. So we're reducing the position, cutting it in half because of the earnings, but then adding a little bit more because of the lower profit loss ratio. Still a good enough profit loss ratio to take the risk on the trade, but it's a lower ratio, which means higher probability of success. Not, obviously not 100%, and it's not a high probability trade. It's just higher than normal. Because of the teeter-totter effect between probability of success and profitability for the risks that you're taking. All right, so that wraps us up for tonight's video. As always, thank you very much for watching. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It goes to our Market Outlook forums. Again, all free subscribers have access to that Market Outlook forum. All of our class forums, of course, are available for our premium subscribers. It's one of the benefits of premium membership is you get access to the community on our website, a big, large community in fact, the bulk of our clients are premium subscribers. So you get access to that community. Again, thanks for watching. Remember to hit that thumbs up icon, comment on our video down below, and subscribe to our YouTube channel. Follow me on Twitter for more content and join our site as well as our community group page that we've created on Facebook. Have a great rest of your Thursday evening, everybody. We'll see you all tomorrow.